for not necessarily higher rates, but for more security, right? You know, they would say, hey, I've got over the 250 limit for insurance, and I don't want to.
Yeah, I see. Yep.
I can't lose my money, so I'm going to go to one of these banks that the federal government will never let fail.
I'm very involved with the Center for Commercial Real Estate and Urban Studies at UConn as an SIOR. The CCIMs also get involved up there. What would you say to those students that are in real estate programs or economic programs about the banking industry today, and what might they be pointed towards if they wanted a career in lending or banking?
Well, the path to lending has changed. You know, as I mentioned, when I started with City Trust, there was a credit training program. They had dedicated people that were, I went into production right away as part of the credit staff.
Production means lending.
Production analysis, because you started as a credit analyst. But, now there's no more training programs out there, or if there are, I don't know of any. Even the money center banks, poach each other's, lenders.
Talent. Yep.
I first 20 years of my career, I said I was the youngest banker at every bank I went to, but I wasn't getting any younger. And the answer was there weren't training very many people behind me.
Cool.
And so as a lender, there's a certain level of job security because there's not a lot of younger lenders out there. You'll see a few that will come through perhaps a small business lending program, but those are matrix lenders, and they don't receive the same credit training that you used to as a lender. So I would definitely advise somebody if they were thinking about a career in lending or real estate lending. First one would be think twice about it. And the second one would be I think the action for that sort of stuff is with the the private equity lenders and the family offices and stuff like that, and they have a more entrepreneurial take on real estate lending. So I think would be a great place to cut your teeth.
And I also think that if Ives Bank wanted to hire a young buckaroo, maybe they would tie him to you to try to learn the business as your young junior. As I know in the brokerage business, we're trying to take on team members.
Sure.
I have a young man who's going to be a sophomore now, and he's been my intern this summer, and I got him canvassing, I got him knocking on doors, I've got him reading newspapers and learning how to take the nuggets out of the articles for the real estate terms. But it's a challenge, but it's fun for me to teach.
Sure.
And so that's would be my thing, for those out in the audience that might be in college. Tag on to a real pro like myself or Chad. And thanks for coming up here today to Strike Zone Studios. I'm Tom Hill. I'm a commercial real estate broker. I hold CCIM and SIOR designations. I have my own little commercial boutique firm with my wife, Sandy, called Tom Hill Realty and Investment. And if you want to call me, 203-755-HILL. And Chad, feel free to take a little commercial for Ives Bank since you were nice enough to come all the way up here and visit us today.
Sure. Chad Stewart, commercial lender. If you have a need for a loan or for financing, or if you just want some advice on, how to grow your company and what options are out there for you, feel free to give me a call. My cell phone number is 203-260-6181, and my email is cstewart, C as the letter C, Stewart, Stewart, at ivesbank.com.
And again, an experienced pro, as those who are listening or watching, this fella knows his stuff, and that's why we invited him on. So to keep moving, Lower Fairfield County is called the Gold Coast, and you were talking about, to me previously for show prep, about commercial properties down there, and your question was, will the bubble burst? So first explain to the audience, what is a bubble, and then what is this question pertaining to with the properties? Will the bubble burst?
So, Lower Fairfield County, primarily, Norwalk, Stamford, Bridgeport, the current environment is, one of, cautious optimism, I would call it. We've been very lucky down there in terms of being isolated from much of the last couple of, financial disruptions and economic cycles. So I'm not sure that people remember what a really bad economic cycle looks like. And, as we've discussed before, the landlords, their ability, their pricing power, their ability to increase rent has not improved over the last 10 years. Their occupancy rates have not improved, but expenses have improved. Have increased. The interest rate environment has increased. So there's a lot of pressure on real estate right now. And while I'm hopeful because of some things that we talked about before, such as repurposing or smaller floor plates that attract the smaller user, there is a lot of pressure, and it's going to be interesting to see how we kind of ride this wave. The vacancy number that I heard very recently in Norwalk and Stanford, the number is somewhere between 40 and 45%. And also,
So, folks, that means empty space.
Yeah.
45, as much as 45% of the space
and that's
is empty.
the stated number.
I think some of that has to do, though, with people not going to the office either.
But the whisper number is probably over 50, in terms of space that's going to be given back at the end of a lease term, or space that a larger user might want to renegotiate with the landlord.
Hence, a bank could be saying, I don't want a loan on office buildings.
That is exactly, an issue, is that as these loans come up for either maturity or for repricing date, most loans have a 5 or a 10-year fixed rate, and then they reprice. As that occurs, who's going to be in the market to lend to these entities? So
Wall Street Journal says private credit, and Jamie Dimon from J.P. Morgan is stating one day this week in the Wall Street Journal said that even though he doesn't like it makes him nervous, they're committing billions to it. So the Wall Street Journal states that there's going to be a whole new class of lenders that aren't the banks, but then the government regulators get a little nervous about that, because is that going to cause another bubble or financial trouble years down the road, 3, 4, 5 years out again?
Sure. Is it kicking the can down the road? Is it just transferring that liability from the bank to your wealthiest, individuals? You can sell them on the fact that there are better returns doing private lending than there is in investing in the S&P.
Higher fees. Well, that brings me to your next suggested topic, which, thank you very much. I love guests that do their homework. Not that I couldn't have handled this without any notes, Chad. But you were talking about would lower interest rates be good for banks and or borrowers? And we talked about interest rates and amortization schedules on our private money talk recently here. But what do you think about interest rates being good for the bank or good for the borrowers? And I think a loan on a house now is 6.8%, and there must be a similar cost for a commercial loan too, I would imagine.
Yeah, it's probably a little bit more, but I'm thinking more in a macro sense. As interest rates decline, what happens? Well, banks want to be able to reduce the amount that they're paying on interest on deposits. But right now, there's a huge squeeze on deposits across the board. I mean, when Silicon Valley Bank tanked and First Republic had its challenges,
It was all within the last 2 years.
Exactly. There was a lot of deposits that left the community banking and regional banking system and went to the too big to fail, the Bank of America, the Chase, the Wells Fargo.
And for higher rates, right?
For not necessarily higher rates, but for more security, right? They would say, hey, I've got over the 250 limit for insurance, and I don't want to lose.
Yep.
I can't lose my money, so I'm going to go to one of these banks that the federal government will never let fail. So what that causes, it caused a constriction with the regional and the community bank, where their deposits left. Their largest deposit holders said, hey, we need some security. And some of that has come back, and there's some answers for that. But if you squeeze that with lower interest rates, as banks are kind of in a juggling act, because if they lower the rates on their deposits too much, they'll go someplace else. They can go to an internet bank, an Ally, or a American Express Bank.
We're calling the bank Ives and saying when it's one of our CDs is rolling, yes, we'd like more. So that's a natural thing. Everybody wants to get what they can. And the sad thing about this country, and this is one we'll talk about Mr. Jerome Powell a little later, but there's been a lot of complaints. I think the elderly, before this jump in savings and collecting more money on your money, I mean, for years you were lucky if you get 0.5% on your savings account. And I think the elderly that needed to live off their savings really took a beating.
One of my other sidelights at one point, I was a certified financial planner, so I have a little bit of knowledge into that area. And, the reduction in interest rates really hurt, it hurt a lot of your pension calculations and your cost of living, increases for your Social Security. So it does have impacts across the board, but it also drove down any of your borrowing costs. So if you needed to refinance your home, or if you needed to refinance your car loan or whatever.
If you were a borrower, great.
Yeah.
Saver, no.
Exactly.
That CFP, tell folks about that designation. That's I think that's highly recognized and a really great designation.
Well, I'm not. I let it lapse a while ago, but it's a certified financial planner. So
good background, though.
Yeah, it makes me just a little bit of knowledge. It makes me dangerous.
A little bit of knowledge is a dangerous thing.
You told me there'd be no singing.
That's me. All right, happy to do it. Okay, so you're on Strike Zone Studios, the Tom Hill podcast. Bob the Builder is throwing baseballs downstairs, so we don't have him today. You can see him on our YouTube channel, and TomHillRadio.com has a bunch of these podcasts on a lot of different subjects, etc. And if you want to write to us about questions or guests you'd like to see, sales@TomHill.com, sales@TomHill.com. All right, so everybody's talking to me about tariffs. You see competing articles of the pluses and minuses in every newspaper, every radio show, Fox versus MSNBC and the big networks. So impacts of tariffs on businesses and possible unintended consequences, Mr. Chad.
Wow, that sounds like a great question. I don't know who wrote that. So, first, tariffs, we're addressing it in the banking world because it impacts negatively construction loans, right? If you can't count on how much you're going to spend on steel, or how much you're going to spend on lumber that comes from Canada, or how much you're going to spend on your electrical components that are imported from China, it's
or take a year to get.
Well, yeah. Plus that, I guess that's a double whammy there. It makes it very difficult to adhere to a construction budget, and if you can't adhere to your construction budget and you have cost overruns, then you either have to borrow more money,
or dig into your pocket if you have it.
Dig into your pocket and use your additional equity. So it really is a crapshoot sometimes with these construction, because not only are you talking about what is the current situation, but if it takes 18 months to build the building, or who knows what the economic environment is going to be like at that time. So it's construction lending is slowed down tremendously.
Is this why, though, some banks don't even get involved in construction lending? But when I had your colleague Stephanie Hayes on, she said, "Oh no, we loan to construction." So is there an extra skill set needed for your bank to stay in it?
Cojones. You need to stay the course and stick to your knitting. If you know what you're doing with construction lending, and construction lending, you want to work with a strong sponsor who's done it before, who has
a builder with experience,
or the investor who hires the right builder to build for. You want to invest in the team, and you want to invest in experience. It's not the time for a first time builder to be out there looking for financing, or if it is, you have to do that with your own equity right now. It's not going to be
well with that that new builder. Would he be able to get 50% financing if he had a good signature and good credit, or just forget him and only go for the real experienced people?
No, it really depends. But I would say that there's plenty of hard money fix and flip lenders out there that know that business and are a little more predatory might be the wrong word, but opportunistic, I guess, would be a better.
Well, we have around Waterbury, we've had plenty of predatory hard money lenders that they call it loan to own. But then again, I have a fellow that I've dealt with over the years that even though he needed 13%, he was honorable and he would explain the loan. And if the deal made sense, many people still did it. But would you please just give us, I probably can't get any hard lenders to go on the microphone. So would you just tell us briefly in a paragraph or two, what is hard money for the uneducated or people that never had to borrow hard money?
Hard money is, it doesn't feel good, like when you're signing the papers. Hard money, is generally characterized by, it's a 2-point origination. It's a 12% interest rate, and it's at somewhere, between 60 and 90% loan to value, depending on how skilled you are at, fix and flip loans or, renovations for apartment building or something like that. And you called it loan to own, but most yes. Well, most hard money lenders look at it differently. A banker looks at how am I getting paid back. The hard money lender said, would I mind owning this property at the end? So that's
the people can't make the high payments,
right? A very different mindset.
Yeah, and you have to, and if it's a borrower though, you have to do your economics, and is the money worth borrowing? Because at the end you have a big profit and you can afford that financing. So it's quite an arithmetic analysis. And then to your point, well stated, what does the market look like maybe on the fix and flip at the year? What's the market look like at a year? And you said earlier on a construction loan, what does it look like in 18 months when the building is built? So interesting, complicated. A lot of money can be made at this, but you can lose your shirt.
Well, the first bank I was with, City Trust Bank, had a program. It was called Shared Appreciation Loans. Shared Appreciation. So basically it was recruiting experienced developers, say, hey, you provide your expertise, you build this project out, we'll provide 100% of the money or somewhere close to that. And at the end, once our money is recouped from our loan, we'll split the profits. Great for the developer, great for the bank. But what happened was, 1989, 1990, the economy began to slide. The developers didn't have any skin in the game, so they started giving the keys back to the banks. And instead of being shared appreciation, they were shared depreciation loans. And basically, it put City Trust on its heels before the big credit crisis hit and kind of wiped it out. So I think, most banks have learned from experiences very similar and are now more rigid with their standards.
I call myself a scarred broker. Learned everything the hard way.